Hello everyone and welcome to these online installments of our Chapter 6 discussion. Quick little recap of where we left off. We've already been through Chapter 5 covering this top section here leading up to gross income, so everything that goes into our tax return. And then the first half of Chapter 6 we covered the above the line deductions, the deductions for AGI. So we spent a lot of time in this class so far just trying to figure out what this adjusted gross income number is. And a big reason that that number is important is really leading up to the last half of Chapter 6, where we're trying to figure out if we are able to take itemized deductions. As many of you remember from the last lecture, a lot of these deductions are phased out or limited based on some percentage of this AGI number here. So now that we've done all that work figuring out what AGI is, I'm going to spend the rest of our time here on Chapter 6 really hammering this line number 1 of the deductions from AGI section. Basically trying to figure out, have we done enough this year to be able to take itemized deductions, or have we not, and are we instead just better off taking the standard deduction just provided us by the government? So before we pick up where the slides left off in the last in-class lecture, I do want to point out there's a new addition to your Chapter 6 folder of Blackboard. So if I come down here next to the folder where all of these lectures are contained, there's now this new, it's an Excel document, but it's an itemized deduction summary. And I've got it open here, and basically it's just a high-level summary of the key itemized deductions that are covered in Chapter 6, or at least that are covered in our discussion. This by no means is an exhaustive list of itemized deductions available, but they're kind of the highlights that we're going to focus on in 3307. So before we get back to the PowerPoint, I want to go through first the general rule here about claiming itemized deductions. We talk a lot about kind of what the item is and then what's the limit, the maximum amount we can deduct. But that maximum amount itself is not necessarily our deduction. So maybe I should preface all of this with this first rule here, is that if we're even going to claim an itemized deduction, no matter what it is, we're always looking to deduct the lesser of two amounts. Those two amounts being either what we actually paid or what our deduction has been limited to based on the rules in the code. And it should be noted that this limitation here, the limited deduction amount, it can't be less than 0. So worst case, your itemized deduction is going to be 0. We would never have a negative deduction amount because essentially that would mean that we would recognize even more income by taking a negative deduction. So that does not happen. So basically we are always trying to remember what we actually paid, and if that happens to be more than the rules of the code would allow us to deduct, we got to take the limited amount. Then summarizing here some of these key limitations. You'll recognize some of these formulas from the things I wrote on the board in class last time, but there are some new ones here too. So real quickly, kind of highlighting the ones we actually have talked about a little bit. I've got the medical limitation here, which is simply adding together all of your qualified medical expenses. So everything that you can directly tie to seeing a doctor, going to the hospital, getting some sort of documentation that this expense is medically necessary. This is not cosmetic stuff where you're just going out and maybe getting plastic surgery because you don't like the way you look. This is all legit tied to an actual medical ailment. So we add all of those expenses together that we've paid. We then subtract all of the amounts that we've already been reimbursed for. So these reimbursements are either going to be payments that we got back from our insurance company, or I mentioned it could also just be increases in the fair market value of our home that result from medical changes that we make to our primary residence. Example there is if a doctor tells us that we need a swimming pool to do some aquatic therapy at home. The amount that we spend for the swimming pool would go here in this sum of qualifying medical expenses, but then that pool probably raises the resale value of our home. So We then take out the amount by which our home is more valuable, such that what we're trying to deduct is just sort of that net, the amount that we're out of pocket after we account for that extra little boost we would get if we tried to sell our house. So this quantity here, the sum of everything we spent minus everything that we got back, we then have to cut off 7.5% of AGI. So what this means is if all of your medical expenses after reimbursements, if those don't add up and become greater than the 7.5% of AGI, we're not going to have a medical expense deduction. So of all of the itemized deductions we'll talk about in 3307, medical expenses tend to be the ones that are hardest to meet because of this really steep limitation here based on AGI. It should be noted that basically the rules are here to supplement and subsidize people who kind of need this tax protection the most. It's meant to address medical issues when kind of something really big happens. It's not necessarily going to cover just your day-to-day medical items simply because most people have AGI that's a fairly substantial number, and then 7.5% of that is still a pretty big number. So medical, there's a lot of things that qualify there, but then we're probably still going to be left with a pretty sizable chunk that we just have to pay on our own due to that big, steep limitation. Moving on, there is an itemized deduction allowed for various taxes that we pay to other governments. So this isn't our federal income taxes, it's everything state, local, foreign, sales tax, that sort of thing. So the total amount that we might be able to claim as an itemized deduction related to these other tax payments is, first, we look for the greater of our income taxes that we pay to a state, local, or foreign government, or the state and local sales tax that we pay. So compare whatever income taxes you have at the state, local level for a year, compare that to the state, local sales tax you have for that same year, and take the bigger one. Usually the sales tax number only comes into play when you either live in a state like Texas that doesn't have an income tax, or it just happens to be a big year where maybe you bought a car or a boat or just something large where you had to pay a lot of sales tax all at once. Most of the time, a lot of people are going to wind up taking this income tax piece. Aside from this greater of test for non-federal income taxes and non-federal sales taxes, we could also tack on taxes we paid this year for real estate, so just our normal property taxes, and also any taxes we might have paid on personal property being stuff as opposed to buildings or land. But these personal property taxes have to be assessed on what that property is worth. So a pretty common example we talk about in 3307 is that sometimes with trucking industries, there can be taxes assessed on trucks, and that tax is based on how much the truck weighs. The weight is not the fair market value of the truck, so we would not be able to deduct that here. However, if we paid, say, vehicle registration on our personal vehicles, and that registration amount, that tax that we pay, is dependent on, say, what year our car was made, where, the newer the car, the nicer the car, the higher your tax, that would count. So we could take a deduction for that sort of registration tax. You don't see a lot of these personal property tax examples, but there are some there, and really all that we need to know is that facts matter, and if it's based on the fair market value, they're allowed as an itemized deduction. Otherwise, we just have to ignore them. The next big itemized deduction we talked about last time was investment interest. So this is where you go out and get a loan to then turn around and make investments, and the interest you have to pay back to that party, whether it's a bank or just some other investor who lent you some money, that interest is potentially an itemized deduction. However, it's limited to the amount of income in net that you've received in that same year from that investment you made. So in order to figure out if we get to deduct any of the interest we paid on loans that we took out to make investments, we first have to know how much money did we bring in from that same investment, and then we subtract any other investment expenses we had. So things other than interest, this could be paying brokers at banks or other investment companies. It could just be maybe we get on E-Trade and have to pay some X number of dollars per trade that we make. All of this stuff that's directly tied to the investment that generated this income, we just cut that off. And the net investment income we're left with is then the maximum amount of investment interest we could deduct. So if we paid more investment interest than we had net income from that same investment, we're going to be stuck here, and we just deduct enough of that interest to offset this income, leaving us with a zero impact on taxable income. If we spent less on investment interest than we had over here, then we could use our investment interest, we could deduct the amount we actually paid, and then this net investment income number that flows through to our taxable income is just going to be reduced a little bit. The next one is home mortgage interest. Now, in general, most people are not going to face a limitation on these items, but there are provisions in the code that basically preclude people with extremely nice and expensive homes from taking too much of an interest deduction. So when we talk about the home mortgage interest limitation, the maximum amount that we're going to be able to deduct is, first, the interest we paid this year on our home mortgage for the first $1 million of principal. So if our home costs more than $1 million, we'd have to figure out the amount of interest we paid on that first $1 million of that purchase price. This is not $1 million of interest itself. It's talking about the principal value. In addition to that primary mortgage piece of interest, we could also do the same thing for interest that we paid this year on home equity debt, but the principal cap there is $100,000. So if we have a house that cost us initially less than $1 million, and we have a home equity debt that is less than $100,000, there is no limitation. We could take all of the interest we paid on those two things, add them together, there's our itemized deduction. So this is a very valuable deduction in practice. This is what most people use to trigger itemizing in the first place. And you probably won't be tested too much on these specific limitations. I'll give you facts that either clearly speak to the principal values here, and they'll be either really high above these thresholds or definitely well below. Or if I don't give you that information, you can assume that we're safe, we're under the thresholds. So there won't be any tricks there. The last items here we'll get to through the rest of these slides that I'm about to get to for Chapter 6. But the first kind of main area where we're going to start off today is charitable contributions. So there'll be more on that in the next installment.